Picture this. It is early Saturday morning. You are sitting at your kitchen table with a hot cup of coffee, opening up your latest 401k statement. Your eyes scan down to the bottom line, and there it is, the magic number. Maybe it is $500,000, or maybe you finally crossed that $1,000,000 mark. You take a deep breath and smile. After 40 years of early alarms, stressful commutes, and putting away a little bit out of every paycheck, you actually did it. You hit the finish line. That feeling of relief washing over you is incredibly well-deserved. You built a mountain of savings, and you have every right to be proud of that hard work. For decades, you were told to just keep saving until you hit that big goal, and now that day is finally here. You are ready to kick back, relax, and truly enjoy your golden years. But here's where a quiet, unsettling reality sneaks in for so many hardworking Americans. Why is it that folks can hit their magic number, walk away from their jobs with a huge smile, and then suddenly feel like they are completely broke just 3 years later? It happens all the time, and it is truly heartbreaking. It usually boils down to one massive blind spot that traditional retirement plans simply gloss over. The big mistake is treating that retirement account like a tax-free lottery jackpot, rather than what it actually is, a taxable paycheck. When you stare at that big number on your statement, it feels like it all belongs to you to spend however you want. But the harsh truth is, the money in that account is not entirely yours. There are hidden strings attached, and pulling the wrong string at the wrong time can drain your savings far faster than you ever imagined. Today, we are going to skip the confusing Wall Street jargon and talk about real-world strategies to keep your hard-earned money safe and secure. Stick with me until the end, because I am going to give you a simple, actionable checklist to fix this big mistake and make absolutely sure your nest egg actually lasts as long as you do. Let us dive right in. Let us talk about that big number on your statement for a minute. That number represents your gross savings. To understand what that really means, I want you to picture your retirement account as a beautifully baked, warm apple pie sitting right there on your kitchen counter. You spent decades gathering the ingredients, mixing the dough, and baking it to absolute perfection. Naturally, you look at that beautiful pie and think that entire thing is mine to enjoy. But here's the catch. Before that pie even leaves the kitchen, 2 very hungry guests have already claimed their slices. They are sitting at your dining table with forks in hand, waiting for their share. And trust me, they are not going to ask politely. They are just going to take it. So while your monthly statement shows the whole pie, your net savings, meaning the part you actually get to eat and enjoy, is only what remains after those guests take their cuts. This is the critical difference between gross savings and net reality. Most retirement plans only focus on baking the biggest pie possible, completely ignoring the fact that you simply do not get to keep the whole thing. Why does this mistake catch so many smart, hardworking folks completely off guard? It is because of a massive mindset shift that nobody really prepares us for. Think about your working years. For 40 years, you have been in what the industry calls the accumulation phase. Every single piece of advice you ever heard from friends or coworkers was simply to save, and save some more. Put money in the 401k, get the company match, pick some good funds, and let it grow. Your only job was to build the pile as high as possible. But the day you retire, the rules of the game completely flip upside down. You enter the distribution phase. Suddenly, the goal is no longer about building the pile. It is about figuring out how to take the money out safely so you do not run out of money before you run out of breath. The financial industry spends billions of dollars teaching us how to save our money, but almost no one teaches us how to spend it wisely in retirement. Transitioning from a saver to a spender is emotionally and financially difficult. especially when you realize the rules for taking money out are entirely different from the rules for putting it in. Let us look at a clear, simple math example to show you exactly how this illusion of wealth plays out in real life. Let us say you look at your savings and decide you can comfortably take out $50,000 a year to live on. In your mind, $50,000 sounds like plenty to cover your daily bills, enjoy some well-deserved travel, and live comfortably without worry. That is your gross number. But remember those two hungry guests we just talked about? Once they take their slice of your pie, your actual take-home pay, the money that actually hits your personal checking account to spend, might only be $38,000. Suddenly, your monthly budget feels a whole lot tighter. The extra trips to visit the grandkids or that new hobby you wanted to take up might have to be put on hold just to cover the regular bills. I am not sharing this with you to scare you. I am sharing this to prepare you. When you plan your retirement based on an illusion of wealth, based on the gross number instead of your actual net income, you are setting yourself up for unnecessary stress. By understanding exactly what you actually get to keep, we can build a rock-solid plan together. Let us talk about that first hungry guest sitting at your table. It is probably no surprise that it is our good friend, Uncle Sam. When saving for retirement, most of us put our money into traditional 401ks or traditional IRA accounts. The financial world calls these tax-deferred accounts. Now, tax-deferred is just a fancy way of saying this is money you have not paid a single dime of taxes on yet. You got a nice tax break when you put the money in, and your savings have been growing completely tax-free for decades. The IRS has been incredibly patient with you all these years, but let me tell you, the minute you retire, their patience officially runs out. What happens is that every single dollar you pull out of that traditional retirement account to pay for your groceries, property taxes, or an anniversary dinner is taxed as ordinary income. The federal government, through the Internal Revenue Service, treats those withdrawals exactly like the regular paychecks you used to get from your boss. If you thought you were done paying income taxes just because you stopped working, you are in for a rude awakening. That $50,000 you took out of your gross savings, Uncle Sam is going to slice right into it. By the time you pay federal and state taxes, you are left with a much smaller piece of the pie to actually live on. Now, if just paying taxes on the money you need is not frustrating enough, wait until you hear about the RMD surprise. RMD stands for Required Minimum Distribution. That is the official term used by the IRS. I know it sounds like boring tax code, but it is actually one of the most important rules you need to understand. Think of it as the government's ultimate alarm clock. According to the IRS, once you reach age 73, you no longer have a choice in the matter. You absolutely must take a specific minimum amount of money out of your traditional retirement accounts every single year, whether you actually need the money or not. And yes, you must pay taxes on every single dollar they force you to withdraw. If you do not pull that exact amount out by the December 31st deadline, or by April 1st of the year following the year you turn 73 for your very first RMD, the IRS will hit you with a significant penalty. Under current law, that penalty is 25% of the amount you failed to withdraw, though it can be reduced to 10% if you correct the mistake promptly. Here is the real danger with RMDs. Let us say you are living a perfectly comfortable life, managing your budget well, and keeping your withdrawals low to save on taxes. Then, suddenly, your RMD age hits. The government forces you to pull out a chunk of money. That forced withdrawal gets piled right on top of your other income, and it can unexpectedly bump you into a completely higher tax bracket. Suddenly, you are paying a much higher tax rate on your own money, simply because you were forced to withdraw it. But wait, it actually gets worse. And this brings us to the absolute biggest blind spot for American retirees today: the Social Security tax shock. For years, many of us assumed that once we claimed our Social Security benefits, that money was ours to keep, free and clear. After all, you paid into the system your entire working life. Why in the world would you be taxed on it again? Well, I am sorry to be the bearer of bad news, but Social Security is not always tax-free. Here is how the trap snaps shut. Both the IRS and the Social Security Administration look at something called your combined income, sometimes called provisional income, to decide if your Social Security should be taxed. According to the Social Security Administration, combined income is calculated as your adjusted gross income, plus any non-taxable interest you earned, plus 1/2 of your annual Social Security benefits. And guess what counts heavily toward that combined income? Those forced RMD withdrawals and regular distributions from your traditional 401k. According to SSA rules, if you file your taxes as an individual and your combined income exceeds $25,000, a portion of your Social Security becomes taxable. If it exceeds $34,000, then up to 85% of your Social Security benefits can be subject to federal income tax. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. So if you pull too much money out of your retirement account, say to fix the roof or buy a new car, you do not just pay taxes on that withdrawal. That extra income can trigger taxes on up to 85% of your hard-earned Social Security benefits. Let me repeat that. Up to 85% of your Social Security could suddenly become taxable income just because you needed to take your own money out. It is incredibly frustrating, isn't it? It feels like you are being penalized for doing exactly what you were supposed to do. You worked hard, you saved diligently, and now you are getting taxed on multiple streams at once. It is enough to make anyone want to pull their hair out. This is exactly why looking at your retirement as just a pile of money is so dangerous. Pulling a string over here with your 401k causes a massive knot over there with your Social Security. If you do not plan for these hidden tax triggers, your beautiful apple pie will disappear before you take a bite. Let us move on to the second hungry guest sitting right there at your retirement table. For a lot of folks, this one comes as an even bigger shock than the tax bill. I call it the Medicare mirage. There is this massive, almost universal misconception out there in America. We somehow got it into our heads that the moment we blow out the candles on our 65th birthday cake, our healthcare is magically 100% free for the rest of our lives. And honestly, it is entirely easy to see why we think that way. You have seen that Medicare tax deducted from every single one of your paychecks for 40 solid years. It feels exactly like you prepaid for the service, right? Well, while Medicare is a fantastic program and a true lifesaver for millions of older Americans, it is absolutely not free. It is what we call a shared cost system. The government certainly pays a large portion, but you are still responsible for paying your fair share out of your own pocket. If you step into retirement believing you can completely cross medical expenses off your monthly budget, that second hungry guest is going to take a huge bite out of your savings pie before you even realize what happened. To understand exactly how this guest eats into your savings, we need to break down the Medicare alphabet. And we are going to keep this incredibly simple. When you enroll, you are looking at a few different parts administered by the Centers for Medicare and Medicaid Services, known as CMS. First up is Part A. This is your hospital coverage. The good news here is that for the vast majority of people who worked and paid Medicare taxes for at least 10 years, Part A is usually premium-free. If you have a major hospital stay, this part helps cover the room and board. But then we get to Part B. Part B covers your regular doctor visits, your preventative care, and your outpatient services. This one is absolutely not free. Part B comes with a standard monthly premium. In 2026, the standard Part B premium is $202.90 per person per month. Here's the part that catches so many folks completely off guard. The government usually deducts that premium directly from your Social Security check before that money ever hits your personal bank account. You never even see it. So if you were expecting a certain amount from Social Security to pay your mortgage or buy groceries, you have to remember that Medicare is taking their cut first. Finally, we have Part D, which covers prescription drugs. Those daily medications are not handed out for free. Part D requires you to pay monthly premiums. Plus, you still have out-of-pocket costs like deductibles and co-pays at the pharmacy counter. When you add up the premiums for Part B, the premiums for Part D, and your regular out-of-pocket costs, healthcare becomes a permanent, significant line item in your budget. Now, if regular premiums were the end of the story, that would be one thing. But there is a rule built into Medicare that I call the success penalty. The government officially calls it IRMAA, the Income-Related Monthly Adjustment Amount. The Social Security Administration oversees this surcharge. In plain English, this means that if you show a higher income, Medicare will charge you additional premiums on top of the standard rates for your Part B and Part D coverage. And here is the key fact. Your neighbor who saved less pays the same base premium as you, but you pay significantly more. For 2026, the IRMAA surcharge kicks in for individuals whose modified adjusted gross income from their 2024 tax return exceeded $109,000 or $218,000 for married couples filing jointly. The SSA sends you an official notice called the Initial IRMA Determination if you are subject to these higher amounts. And here is exactly how this ties right back into our first hungry guest, the tax time bomb. Remember how we said that pulling a big chunk of money out of your traditional 401k counts as ordinary income? Well, if you decide to pull out an extra $50,000 to remodel your kitchen or buy a new vehicle, that suddenly spikes your income for the year. Not only does that trigger higher income taxes, and not only does it cause your Social Security to become taxable, but it can also directly trigger that IRMAA surcharge. Pulling your own money out of your own account could make your healthcare significantly more expensive. It is a massive domino effect. Taking too much money from the wrong bucket does not just raise your taxes, it raises your medical bills too. And just like that, the two hungry guests have eaten half your pie. Now let us talk about a silent drain on your retirement savings that does not send you a bill in the mail. I am talking about inflation. Think back to roughly 10 years ago, around 2016. If you walked into a store to buy a standard pound of ground coffee, it probably cost you around $4.50. Today, you are paying over $9 for that exact same bag. The same thing happened to a carton of eggs. A dozen eggs used to be well under $2, and now prices have regularly climbed to $4 or more. That is inflation in the real world. Now, imagine a retirement stretching 20 or 30 years. If a simple pound of coffee can double in price in just one decade, you have to plan for the cost of absolutely everything to rise significantly over the course of your retirement. If your plan does not account for these steadily rising prices, your purchasing power will slowly vanish right before your eyes. This brings us to a phrase that honestly worries me every single time I hear it. Folks proudly say, "I am on a fixed income now." I understand exactly why people say it, but living on a fixed income is actually a massive flaw in any retirement strategy. Think about it logically. Your income might be fixed, but the world around you is not. Your county will keep raising your property taxes. The electric company will keep raising utility rates. The grocery store will keep raising the price of food. If your income stays perfectly flat while your living expenses climb higher and higher, the only possible result is that your lifestyle will slowly shrink. You will find yourself clipping more coupons, saying no to family trips, and worrying about turning on the air conditioner during the summer. To truly retire smart, you cannot settle for a fixed income. You need a growing income. Your investments and withdrawal strategies must be carefully designed to give yourself a pay raise every single year just to keep pace with the rising cost of living. Finally, we have to talk about a hidden danger the industry calls the sequence of returns risk. Let us skip the jargon and look at a simple analogy. Imagine you are trying to sell your family home, but you are forced to sell right in the middle of a housing market crash. You would take a massive financial loss just to get out. You would never willingly sell your house when prices are at rock bottom. The exact same rule applies to your retirement investments. If the stock market drops significantly during the first few years of your retirement and you are forced to sell off investments just to pay for daily living expenses, you are locking in those major losses. You are forced to sell your investments while they are on sale. Because you sold those shares at the bottom, they are gone forever. They will never recover when the market eventually bounces back. This early drain can permanently damage your entire nest egg. That is why it is absolutely critical to have a safe cash buffer to draw from during bad market years, so you never sell at a loss. All right, take a deep breath. I know we just talked about some heavy stuff. Taxes, hidden Medicare premiums, and the very real dangers of inflation. It can feel a little overwhelming when you realize exactly how many hands are reaching into your retirement pie. But here is the best part. You are catching this mistake right now, and it is completely fixable. You do not have to be a victim to these hidden costs. We are going to flip the script, take back control, and make sure you are the one deciding how your money is spent. Let us walk through a simple 3-step plan to fix this mistake for good. Stop looking at that gross number on your investment statement and thinking that is what you have to spend. From now on, whenever you look at your budget or think about taking a distribution, automatically deduct 15 to 20% right off the top. Just pretend that money does not exist. If you plan to pull out $4,000 a month, immediately set aside $800 for taxes. That leaves you with $3,200. That is your true, realistic baseline. By forcing yourself to look at the net number instead of the gross number, you will never accidentally overspend, and you will never be hit with a massive, terrifying tax bill the following April. You cannot just lump medical costs in with your general emergency fund or your grocery budget. Healthcare in retirement is a permanent, massive expense that requires its own specific line item in your monthly budget. Independent research estimates suggest that a typical couple retiring today may need well over $300,000 just to cover out-of-pocket healthcare costs and premiums throughout their retirement. And that does not even include long-term care. That is why you must plan for this right now. You need a dedicated cash buffer specifically meant to pay those Medicare Part B premiums, Part D costs, pharmacy deductibles, and potential IRMAA surcharges. When you build this buffer into your budget before you retire, those medical bills become a planned expense, not a stressful emergency. This is your ultimate defense against the tax time bomb. Right now, most of your money is probably sitting in traditional tax-deferred accounts, meaning you have no idea what the government will charge you in taxes down the road. You can fix this by gradually shifting some of that money into a Roth IRA through what is called a Roth conversion. When you do a Roth conversion, you are choosing to pay the tax now at today's known tax rates. Once that money is inside the Roth, it grows completely tax-free. And more importantly, it comes out completely tax-free in retirement. This gives you control over your income. If taxes go up in the future, or if you need a large chunk of money for a new roof, you can pull it from your Roth account without paying a dime in taxes, without triggering taxes on your Social Security, and without increasing your Medicare IRMAA premiums. Paying a little tax now can buy you permanent financial freedom later. Retirement is supposed to be the best chapter of your life, a time for joy, for family, and for finally taking those trips you have always dreamed about. It is certainly not a time to be sitting up late at night, stressing over hidden bills. Just knowing about these hungry guests before you retire is 90% of the battle. By taking control and using the 3 steps we talked about today, you are already way ahead of the curve. You can absolutely do this.